The Federal Reserve deciding to hold rates steady. Meanwhile, U.S. Treasury Department says it will slow the pace of increases in its longer-dated debt auctions. So where does this leave the future path for Treasury yields? Here to discuss, we have Luis Alvarado, Wells Fargo Investment Institute Global Fixed Income Strategist, along with Ella Hoda, Newton Investment Management Head of Fixed Income. So Luis, let me just start with you and get your reaction to the news we have so far from the Fed.
Yeah, definitely. Thank you so much. As expected, the Fed decided to maintain its policy rate on hold. I don't think the Fed really came out to shock the markets. They are really waiting and wanting to proceed cautiously. Obviously, in the statement, as it was described, financial conditions have tightened in the economy, and they want to proceed cautiously.
Ella, what do you want to hear from this press conference? I mean, we know we didn't get much from the statement, right? There was no change. Not sure exactly what's going to happen in December. What do you think is the most important question for Jay Powell going into this press conference?
Well, clearly the view on the economy and wages, right? So the labor market has been a little bit softer, but we're coming from very strong levels. And, in terms of the cycle, the economy itself, we've also seen a few data points that are saying things are softening, but we're again coming from a very high nominal level. So it's very early days yet, to say whether they're completely done with regards to the hiking path. So I think he's probably going to want to buy some space to allow the Fed to be able to re-engage should the weakness in the cycle be less than what has been anticipated.
And Luis, just also to you on that question, what do you think is the rate hiking campaign from here? There's any number of economists and strategists we've had on who think, listen, they're done. They can hold here. Is that your sense, or do you think, no, perhaps the market is wrong here and there could be another hike in the pipeline?
Yeah, definitely. We are definitely on more hikes potentially on the pipeline. Definitely inflation is a big threat. We're coming from a strong third quarter, strong unemployment still. Definitely underneath the surface, you're starting to see some things slow down, but that's not enough ammunition for the Fed to really come back and say the job on inflation is done. Actually, inflation is tricky, and they have the playbook going back to the 70s and 80s where you see inflation coming down but then staying sticky. And then what happened in the 70s is that it climbed back again. So they are afraid they're going to get the pedal off too soon. And obviously, Chair Powell and the rest of the committee want to make sure that they really hammer this on inflation. So in our views, there's definitely more potential rate hikes, especially if we continue to see this strong economy on unemployment levels that are still fairly low. And we still believe that there's probably another rate hike for December. That could be 50-50. There's going to be a lot of incoming data coming in. But if we continue to see all this sort of benign incoming data, then we're not discounting the fact that we could see more rates potentially in January and then in March in 2024.
So I have a question then for both of you. And Ella, I'll ask you first. Have we seen the peak in yields here as a result of federal interest rate policy? And obviously it matters what the Fed is going to do from here, but is 5% the peak in the 10-year, for example?
It's a very difficult question to answer, and I think it's because the bond market has been so tempted to say this is it, surely we're there yet, and we've reached this magical 5%, and what's so special about 5%, right? So look, I mean, as you approach cash levels in terms of Treasury yields, which we've done, so we've made good progress on that over the last few months. You can argue that there's some value in bonds, right? So you could argue that the asymmetry, particularly in Treasuries, starts to look interesting. So if you look at 10-year yields, there's more ways to make money than lose money. And even if yields don't change, you can at least start to match your cash returns more or less. You're close to doing that. So that's what's interesting for us as investors. So you can start to own exposure there. Are we done yet? I mean, a lot of investors have been trying to catch a falling knife. You've been looking at the price action on TLT, the large famous ETF. That's been telling you that, until that flow is potentially close to capitulation, that you probably are not potentially done yet with a sell-off. So you can accumulate exposure here, assuming that we might be close to the end of the hikes and the end of bond yield rises. But I wouldn't be sure. I wouldn't be staking my house on that.
And it is a difficult call. Luis, though, what do you think on this point?
Yeah, definitely. From our point of view, we still believe that there's still upside pressure for yields from this point on. Obviously, there are a lot of fiscal problems that are still roaming around. We also believe that a lot of pressure from the issuance that is going to happen from the Treasury. So technicals, right? That supply demand, we're starting to see also some of those buyers, foreign buyers like China and Japan stepping out. So that's going to keep technicals pretty much tight in there because of this extra supply coming into the market, not a lot of demand. On the other hand, until the Fed decides to kind of pivot and move towards maybe holding more openly and even cutting, we still believe that there's still more pressure for the yield curve in the near term. Now, what is going to be a deciding factor, of course, is if we do have that economic slowdown or recession into 2024, and if this financial conditions tightening, which is what the statement kind of alluded to, it starts taking a toll on the economy, we could see longer-term yields starting to decline ahead of the Fed, where the market is eventually expecting some rate cuts to happen some part in the second half.